Hi, and welcome to The Full Perspective. I'm Charlie Thomas, the Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's senior staff to dig into some of the week's most significant stories. This week I'm joined by Insurance Insider's Managing Editor Catrin. Hi Catrin, thanks for being with us.
Hi.
And Inside P&C's Director of Research, Gavin Davis. Hi Gavin.
Hi, Charlie. Thanks for having me on, even though I haven't been able to get a haircut or have a shave for a long time. It's days like this, I feel like I'm more suited for the radio right now.
Oh, bless you. Well, I'm sure everyone at home is in much the same boat, so don't worry too much about it. Well, this week it's been a hell of a week for news, as I'm sure all of our guys at home can appreciate. First up this week, we're going to look at the US and the potential for losses coming out of the George Floyd protests. Catrin, you've been looking at the property market reaction. Just bring us up to speed with where we are currently.
Sure. So obviously the situation is evolving every day. There's still a lot of uncertainty around any losses that may arise from any property damage or looting which may have come out of the protests. Now, this is interesting about the US because strikes and riots and civil commotion is typically covered under an all risks policy or a property policy. It's not typically covered under the standalone political violence market. So this is very much a property issue, and we're kind of expecting a loss event which is split between the US and London markets, and particularly within London Lloyd's. And I suppose it really depends, really. It's quite a multifaceted type of loss picture. So there's been, or what we can see from the media coverage, there has been some damage to sort of small commercial and retail units, and that sort of stuff tends to be covered either by sort of the US commercial insurers, or it goes through the binding authorities into London. You've also got the kind of big ticket retail accounts. So the big ticket retailers will buy a sort of global or nationwide property account, and we may get some losses from those. With those, I mean, typically they have been dominated in terms of insurance by the big US domestic players. But as we've seen, as we've spoken before in this podcast, that there has been some retrenchment from the US domestic market from those big ticket risks. So recently, London has been taking more and more of that risk. And the same goes for the municipality accounts, which are insured in the direct and facultative market and cover property damage to sort of state infrastructure, so your police stations, churches, stuff like that. So that would also be an area of exposure for the open property market. Now, obviously, there's lots of kind of mitigating factors in this. It could be that lots of the big retailers have sort of big out-of-town retail units which haven't been as affected by any damage. Some of these carriers with the hardening market have been pushing for higher deductibles. So it could be that these losses just get absorbed within that self-insurance and they won't affect the property market. And then there's also kind of sort of depending on the insured, they may buy a separate strikes and riots and civil commotion coverage. They may buy a separate stock throughput policy, which would cover looting. Now, the looting also would actually generally be covered under a property policy, and a couple of sources in London have actually noted to me that looting was actually one of the biggest single risk claims from Katrina. So there is actually exposure there as well.
That's a great overview. Thanks very much. Can you just explain to me how this compares to those riots in Chile that we saw at the end of last year?
Sure. So, with the Chile riots, there was actually a kind of wording quirk there. So again, the property market did pick up the bill for any damage that came out of the riots, but there was a kind of a very specific wording which was used for Chile, which was around per location. There were some hours clauses in there, which actually meant that instead of the losses aggregating and going up the tower, they were actually taken multiple times by the lead carrier, or maybe just going into the first excess layer and creating far more of a sideways loss. That doesn't seem to be the case for these US losses. It seems to be each and every occurrence wording, which means it will just kind of aggregate through the tower. However, at the moment, speaking to people in London anyway, they've said to me that they don't feel like it would affect property treaties at the moment. So it does seem to be an insurance loss, but obviously the situation is evolving really quickly.
Okay, that's great. Thank you. And obviously this is coming at a time where, this is coming on the back of all that uncertainty for the property market around COVID-19, right, which could play into rates. And that's not even thinking about things like the Q2 property losses that we're expecting, and have started to see come through.
Yeah, sure. I mean, this is all kind of adding to the big uncertainty. We spoke before about DNF rating momentum gathering acceleration, and also kind of property underwriters in London calling the best market since 9/11. This is all just going to play into this even more and probably fuel that rate momentum a little bit further. But I know that Gavin's been looking a little bit into the property losses that potentially may come through in Q2 from the US, Gavin.
Yeah, I mean, I sort of wanted to broaden it out a little bit, not speak about the property losses per se, but I think what this speaks to when you talk about the level of uncertainty this brings and this coming on the back of COVID, I think what it really points to is a period of peak risk. There's been a lot of talk around peak opportunity, and we've been writing a lot about it recently about a period of peak risk. Some of the opportunity stuff, I think, may be a little early while there's so much uncertainty. But I think certainly, the fact that so many of these events are coming away from what is probably budgeted, it's away from what is in the base case, it's not typically in the models, means that there's just less buffer for unexpected, what you might call known unknowns, like a bigger cat season. And let's just think about a couple of those things for a second. One is if you just think about the protest, I think that is symptomatic of elevated political risk at the moment. If you think about the fact we were living in sort of a trend towards populism and in our politics in general across many parts of the globe, one of the things the pandemic has left us with is an almost absurd degree of separation between financial markets and the real economy. And you have a situation where you have perhaps record unemployment or close to, combined with financial markets at near record highs. And I think that sort of speaks to an exacerbated political risk that may affect insurers in lots of ways. For instance, around fiscal policy, when you've got a lot of debt accruing, a lot of governments around the globe. So I think that's one angle. The other is to say that we're still in a pandemic, and though maybe our focus has shifted, the fact that we have so many people gathering in small areas in uncontrolled ways with lack of social distancing, I mean, that just elevates the risk around the existing COVID uncertainty. And, I'm not an epidemiologist, but it would seem to me that if we think social distancing is important, this increases the risk of a second wave. Maybe there's some issues where weather effects and being outside and masked that might mitigate that. But it's certainly something that we don't know how this is going to play out. And the final thing is to say is, we've had a lot of losses. Maybe we don't know exactly what the situation is, but we still have the big known unknown of the cat season to come. And, people talk about it being an elevated hurricane season. I don't necessarily know what that means, and I don't necessarily know that that's ever been predictive of anything. It's probably a bit more random than that. So that's really my summary, is just that the more these things keep adding up, the more risk piles on, and maybe we don't know what the consequences are, but it's certainly a period of peak risk. And I'll just finish by saying, I think some of the rhetoric we've seen around the opportunity and the best market since whenever, I think part of it is a little self-motivated. People want to talk up the loss. They want to talk the market into turning. And I totally get that. But I guess I would just say that I am skeptical that we're there yet. And I think that we would need to see more pain and more fear before we could really get there. But certainly we're the closest we've been for a long time. And if you think about it in a sort of probabilistic sense and the things that can go wrong, we're definitely not a million miles from there.
Yeah, I mean, it's an interesting timing, isn't it? Because, and you alluded, and Catrin alluded as well, that certainly in London, there's a lot of rhetoric about this being the best market for decades for property DNF, which made the surprising bit of news that Antares has pulled out of property DNF all the more puzzling, right, Catrin?
Yeah, definitely. That was a bit of a surprise piece of news this week, as caused a lot of sort of bafflement in the wider London DNF market. But I guess we'll look into it a bit more. Okay,
well, let's leave that one there for now. We're going to head to Bermuda next and talk through the news that RenRe raised $913 million through a common share offering. Gavin, why don't you give us your take on that?
Yeah, how long do we have? No, I think a couple of points just to sort of start with. It's the first time they've raised equity capital in a public offering since 2001. They have issued in a private placement to State Farm, I think in 2005 from memory, and they've issued stock as part of M&A. But as a public offering, this is the first time. And I think an important headline takeaway is that it has been widely seen as offensive. Given the context of everything we just talked about. And Ren are often seen as the smartest guys in the room. People are thinking this is Ren being on the front foot. This is offensive. And I think maybe it's a bit more complicated than that. And I want to go through 3 quick points. The first is, let's step back away from Ren for a second. I think one of the interesting takeaways here is that it maybe changes the permission structure for other companies looking at their options around capital. Because, I mean, the analogy I might use is when Excel and Ace, as it was back then, now Chubb, entered into M&A in the sort of 2014, 2015 cycle, conducting transactions that led to big tangible equity. The fact that they were able to sell those to investors and make them look past the dilution and look to earnings growth. Suddenly it was open season on M&A because people saw that investors were willing to swallow that type of transaction. If you look at Ren and then also Hiscox before them, both stocks went up 5% on the day they issued equity. And I think, especially with Hiscox, where there was a lot of heightened scrutiny around their potential exposures, I think that was kind of interesting, maybe even surprising, maybe even astonishing. So I think people will look at that and say, well, hey, the money is there. Like people are offering us the money, and then why not take it? So I think some people will look at that and say, hey, this is an opportunity to play offense. And if they genuinely believe that rhetoric around the best market since whenever, well, hey, here is the opportunity to do it. And even if you're not 100% sure, you might say, well, I want the capital and I want the optionality to do it. And it also improves my buffers against anything that can go wrong. And finally, we're still in a consolidating industry and all those things. When this opportunity passes, you want to be one of the people at the end who are surviving, who's got the excess capital, and who gets to stay independent and survive and consolidate others. So there's a lot of incentives there to say, if you can raise money and people give it to you at a good price, you take it. It's harder for people who aren't like Ren, who are trading below book value because it's dilution issues. But for anyone who's in that boat, I mean, why not? The other thing to say is the permission structure of the offense narrative will probably be misused by some people as well who need to play defense. And if you think about the situation we came into, 20 years ago at the start of 2020, as it feels to me, we were talking a lot about balance sheet weakness. We're talking about reserve problems coming from the last soft market. We're talking about people needing to fill those holes. A lot of people may use the narrative of offense to fill the balance sheet holes and raise capital and raise money, maybe not consciously because that would be illegal, but we wouldn't be surprised to see that tacitly happen along the way.
I was going to ask actually, how much of this is a function of the fact that the retro market is effectively non-functioning currently, and that third-party capital is harder to come by? How much of it is to do with that, and how much of it to do is with the Ren factor, if you like, the fact that they are in an all-star position and are the smartest guys in the room, to use your terminology?
Where you preempted my second point perfectly. I think that's spot on. I think one of the things that I would say why I said it's a bit more complicated about being just such a pure bull signal, I don't necessarily think this is Ren saying, you'd have to ask them, but it's not necessarily them just saying, hey, there's such a big opportunity, we need to get the money in the door right now. Apart from anything, there's not that many renewals between now and 1/1. That's a long time to have money sitting on your balance sheet doing nothing and earning 1%, 0.5%. I mean, I don't know what it is. So if this is a 1/1 play, it's not clear to me why you would do it now. And I think it's important to bear in mind that Ren has traditionally been a mid-year retro buyer. It has traditionally tried to write its portfolio, and then once it knows it's in force, it then tries to optimize its risk reward by laying off and hedging and using retro in smart ways. I think the timing of this right after 6/1 sort of speaks to that probably they've written a lot of business. They looked at the best way to optimize their capital structure, and they used equity. Now that is kind of astonishing in lots of ways, and we'll come to that in a second. But I think it points to two things, right? One is you can say it's a bull signal around opportunity, but on the other hand, equity capital is more expensive from a cost of capital perspective than retro. And one of the ways that a lot of cap reinsurers are function is to sort of arb the retro markets. And so in some ways, pricing has to go up just to cover the increased cost of capital, right? The other is to say that also means that reinsurers who used to use retro are now taking more tail risk. And again, if you're taking more tail risk, that means pricing has to go up. So there's an interesting story here around whether pricing is going up more than risk assumed and cost of capital. And I don't think without more information, I don't think anyone can answer that question confidently. And I'm not trying to for sure, but I think it is a question that we need to have on the table. The other point I'd make there is traditionally, you might think of this as what makes a hard market, right? It's like the people are forced to raise prices because retro is taken away. But the two problems there is one is I'm not entirely sure who the winner is in that example. If you're talking about the likes of Ren and the Insider published today about Everest pulling its mid-year program, it's not clear to me that if these are the people taking out retro and having to raise prices, who the winners are. There's a lot of retro dependent people out there who've been using it. And the other is, a traditional function of hard markets has been the new capital comes in, and they're the people who generate from payback pricing. So the question here is, are we going to see that? Because a lot of the new capital that has come into this industry over the last, decade, 2 decades, it's not as if the more recent entrants have done really well. It's not like we're looking to 1992 and Ren has done amazingly, or Everest, or the 2001 class. If you look to some of the more recent iterations from 2005, 2008, and other sort of, let's say, third-party capital entrants in recent years, not all of them have done that well. And I think that becomes a harder sell to, say, private equity when you're talking about a long term. This isn't about the market opportunity now. If you're raising equity capital and starting a company, this is a long-term story, and it's about industry structure, and it's about your ability to generate returns over long term. And it's not clear to me that there's anything changing in the industry structure that would change that long-term dynamic. Maybe returns are going up, but so is risk, and we have to kind of see how those two balance out before you can make that call.
No, definitely. Well, there's a huge amount for us to consider over the summer months as we head towards, as you say, the next big renewal season in January.
Yeah, and then the third point I'd just make is just, I think that there's something this points to is something we called it inside PNC the untipping point, kind of riffing on what has been a market orthodoxy for a long time around the tipping point. And I think it's sort of a moment and an opportunity to reflect that, maybe only 5 years ago, people were talking about cat reinsurance as decapitalizing. People were talking about them becoming like NFILA, like MGAs, like fund managers. You take away the variable underwriting risk, you get just the performance fees and the management fees, and you de-risk, you decapitalize, and your valuation goes up. And I think it's a moment to say how far we've come from that we've entered into what is an improving market. I think we can all say that. And you see a leading cat reinsurer, maybe the leading cat reinsurer, and a leading fund manager, RenRe, of all the different opportunities it has to raise capital with the different balance sheets it manages, it shows equity capital. And that's just a million miles from where everyone thought we would be, I don't know, even probably until they did it. And it's hard to get a read from that. It's hard to see that Ren is really saying, it's hard to think that they would think that there's a secular hard market with excess returns. The industry structure just doesn't allow it. And I think the reason we're talking about this being the tipping point is we wrote about this with Florida in January. One of the things you have seen is so much money flood into peak risk. But I think some of the flaws in that model are being revealed over the course of several years. And what are those flaws? They've been very dependent on models. Models can be misused. Models are great. I'm not criticizing models, but they can be misused. They can be gamed. And especially when there's information asymmetries between the people who are issuing and the people who are investing, and then incentive structures for the managers doing it that can be flawed. Another is that people thought that you would be able to recycle quickly, right? They think cat is short tail. You can use your capital and you can re-up and recycle. One of the things we've seen is actually the tail on some of these cats can be longer, and trapped collateral limits the ability to recycle capital in the way that they thought they were going to. And then also just some of the people who have put money in have seen weaker returns than they thought they would, and maybe not in the scenarios that they thought. And I think if you want to talk about Florida being a bit misunderstood, I think Irma is the perfect case study, where you look at the ultimate losses that people have now put up for Irma, and you compare it to their reinsurance programs at the time, and a lot of them are near the top of them, and you say, well, hold on, these reinsurance programs say that they're for 1 in 100-year events or 1 in 250-year events, and most people will talk about Irma being a 1 in 10 and a 1 in 8-year event, and those two things just don't sit next to each other. They don't make sense, right? One of those things is wrong. And therefore, you're just looking at this and saying, what has happened is a lot of money has come in and ignored the tail risk. They've said, we're living in a world of low interest rates, central bank interventionism, and we need yield. We look at products like that have yield on a modal outcome basis, but you ignore the tail risk and you ignore it at your peril. And some of that has been revealed, right? That they have been investing, not understanding the risks. As that unwinds, you are seeing capital flight from Florida. You're seeing it in the primary markets. You're seeing it in some of the, quote unquote, alternative capital vehicles. The function we're now seeing is this is leading to an interesting time in reinsurance. More of that risk seems to be flooding into reinsurance, which is an opportunity. That probably means more capital is needed, right? One of the problems with Florida in general that Irma shows is there's probably not enough capital for the true tail risk that exists there. That's an opportunity for a reinsurer, but there's also risk there. As we said before, it increases your tail risks. And so that's really interesting. As we think about the pricing that's going up, we need to think about two things, which is one, it's going up relative to what? Where is our starting point? Because pricing has come down so much over such a long period of time. It takes a long way to get back to even where we were a few years ago. And the Insurance Insider reported, people think we're back to 2012 and 2013. I don't think people were that excited about the market back then. And the other thing is pricing is going up, but so is risk. And how do those two things balance out? I don't know at this point.
No, and I don't think you're alone in that, but you're one of the braver ones to say it. So there we are. Look, that is unfortunately all we've got time for this week. So until next time, everyone, please stay home, keep safe, and we look forward to seeing you again for another episode of The Full Perspective. Thanks, guys.